You've probably had this moment. You decide you want to start investing. You open YouTube. And within 10 minutes you're drowning. One video says stocks are the only proven path to wealth. Another says crypto is the future and anyone not in it now will regret it forever. A third says Forex trading is how the real money moves, and everything else is too slow. 3 completely different answers. All confident. All convincing. And you're left more confused than when you started. So today I'm going to settle this properly. Not based on hype. Not based on what made someone rich in a 6-month YouTube short. But based on how each market actually works, what skill they actually require, and most importantly, which one you should learn first based on where you're starting from. My name is Jack. If you've ever felt stuck choosing where to begin, hit the subscribe button and give this video a thumbs up if this helps. Let's start with stocks. Because understanding stocks first is not a popular opinion. It's a mathematical one. When you buy a stock, you are buying a small piece of an actual business. That business sells products, generates revenue, and over time, if it performs well, becomes more valuable. Your investment grows because the underlying company grows. This is called ownership of a productive asset. Historically, the stock market, specifically broad indexes like the S&P 500, has returned an average of about 10% annually over the last century, according to data from NYU Stern's database on historical market returns. Not every year. Some years are negative. But across decades, the trend has been remarkably consistent. Here's why this matters for learning. Stocks reward patience and basic understanding more than they reward genius. You don't need to predict daily price movements. You need to understand that businesses generally grow over time, and that staying invested captures that growth. This makes stocks the most forgiving market to learn on. Mistakes are survivable. Time heals volatility. Now let's talk about crypto. And let's be honest about what it actually is. Cryptocurrency represents ownership of a digital asset, often tied to a blockchain network rather than a company with revenue or profit. Some cryptocurrencies have genuine technological use cases. Many do not. Unlike stocks, there are no earnings reports, no dividends, and no underlying cash flow to anchor value. Price is driven almost entirely by speculation, sentiment, and adoption narratives. This creates a market with extraordinary volatility. Bitcoin has experienced multiple drawdowns of over 70% throughout its history, according to data tracked by CoinMarketCap. That means an investment can lose more than 2/3 of its value before potentially recovering. For context, that level of volatility in the stock market would be considered a historic crisis. In crypto, it's considered a normal cycle. This doesn't mean crypto is bad. It means crypto requires a different skill entirely. Extreme emotional discipline and the ability to financially and psychologically survive massive swings without panic selling or panic buying. Learning crypto before understanding basic market psychology is like learning to drive on a racetrack before learning to drive on a quiet street. Technically possible. Statistically dangerous. Now let's talk about Forex. And this is where most beginners get seriously misled. Forex is the trading of currency pairs, betting whether one currency will rise or fall against another. It is the largest financial market in the world by trading volume. And it is also, according to multiple broker-disclosed statistics, including data regularly published by regulated firms, a market where the significant majority of retail traders lose money. Some disclosures show loss rates among retail Forex accounts exceeding 70%. Here's why. Forex moves on incredibly thin margins, and most retail trading involves leverage, borrowing money to amplify position size. Leverage doesn't just amplify gains. It amplifies losses at the exact same rate. A small currency movement against you can wipe out a significant portion of your account within minutes. Forex isn't inherently bad. Professional institutional traders use it successfully every single day. But it requires deep understanding of macroeconomics, technical analysis, and extremely disciplined risk management before it becomes survivable, let alone profitable. It is the least forgiving market for beginners specifically because of leverage and speed. So here's the real answer to which one you should learn first. And it's based on a simple principle. Learn the market with the lowest cost of mistakes before moving to markets where mistakes are expensive and fast. Start with stocks. Specifically, start with simple low-cost index funds. This teaches you the foundational principles that apply to every other market. Patience, compound growth, emotional discipline during downturns, understanding what actually drives value. These lessons cost you very little to learn in the stock market because mistakes unfold slowly and recover historically over time. Once you genuinely understand those principles, not just intellectually but through actually experiencing a market downturn and staying invested, you have built the psychological foundation required for higher volatility markets. If you're then curious about crypto, allocate a small percentage of your portfolio, something you can genuinely afford to lose completely, and treat it as a long-term speculative position rather than a primary wealth strategy. This lets you learn the asset class without risking your financial stability. Forex should come last, if at all, and only after deep study of macroeconomics and disciplined risk management, ideally practiced extensively in a demo account before any real money is involved. The leverage and speed of Forex punishes beginners faster than any other market, and that speed gives you no time to learn from small mistakes the way stocks do. Here's the principle underneath all of this. The order you learn markets in should match the cost of getting it wrong. Stocks let you make mistakes slowly and recover. Crypto lets you make mistakes violently but survivably if sized correctly. Forex can end your account before you even understand what happened. Start where mistakes are cheapest. Build real skill and emotional control there. Then, and only then, consider moving toward markets that demand more precision and punish hesitation less forgivingly. Because the goal isn't to learn everything at once. The goal is to still have capital and the wisdom to use it by the time you're ready for the harder lessons. If this gave you clarity, hit subscribe. And tell me honestly, which one have you been most tempted to jump into first, even though you probably know you're not ready? Drop it in the comments.